Tonight, while most of America sleeps, a clock is ticking. And when the Comex opens tomorrow morning, some silver holders are going to wake up to a market that looks nothing like the one they went to bed with. Not because of a news headline, not because of a tweet, but because of something building quietly beneath the surface of the global financial system. Something that most retail investors won't understand until it's already moved. Stay with me, because what I'm about to show you in the next 20 minutes could be the most important financial briefing you watch all week. Here's what we're going to cover today. Why this particular Sunday, this specific Comex Open, is different from the ones that came before it. Why silver, not gold, is sitting at the center of a pressure cooker that's been building for months, and why the people who are most exposed are the ones who think they're the safest. Most investors look at silver and see a shiny metal that goes up when things get scary and comes back down when things calm down. Simple, predictable, boring. But that's not what silver is. Silver is a pressure gauge for the entire global monetary system. And right now, that gauge is reading numbers that should make every serious investor stop and pay attention. By the end of this video, you're going to understand exactly what Comex is, why Sunday openings matter, what the current setup looks like mechanically, and what history tells us tends to happen next. Let's go. Section 1, what is Comex and why does Sunday matter? 1:30 to 4. First, let's establish the battlefield. Comex, the commodity exchange, is the primary futures market where silver and gold prices are set in the United States. It's operated by the CME Group out of Chicago, and it is, for better or worse, the place where the price of silver is discovered every single trading day. Now here's the thing most people don't understand about Comex. The price you see when you buy a silver coin at your local dealer, the price you see when you check a gold chart on your phone, that price is not set by people buying and selling physical metal. It is set by people buying and selling paper contracts, futures contracts, options, derivatives, financial instruments that represent silver, but are not silver. And on any given trading day, the amount of paper silver traded on Comex dwarfs the amount of physical silver that actually exists in Comex vaults. We're talking about leverage ratios that would make your jaw drop. At various points in recent history, for every single ounce of physical silver sitting in a Comex vault, there have been anywhere from 100 to over 400 paper claims on that same ounce. Let that number sink in. 400 people, 1 ounce, 1 share. Now, why does Sunday matter specifically? Because Sunday evening is when Comex futures markets reopen after the weekend. It's the first moment when traders can respond to everything that happened Saturday and Sunday. Geopolitical developments, central bank announcements, currency moves, economic data releases, everything the market couldn't price in during the weekend. Sunday opens are the first look, the first reaction, the first signal. And this Sunday, the backdrop is unusually charged, the pressure building beneath the surface. Now let me paint you a picture of what's been happening in the background. For the past several months, something unusual has been occurring in the physical silver market. It's not on the front page of the Wall Street Journal. It's not trending on financial Twitter. But if you know where to look, the data is right there, clear as day. Physical silver has been flowing out of London vaults and into the United States at a pace that hasn't been seen in years. Why? Part of it is the tariff environment. Traders and institutions have been moving physical metal into the U.S. ahead of potential import duties, trying to lock in delivery inside Comex registered vaults before costs go up. This has created an unusual premium, a spread between London spot prices and Comex futures prices that signals genuine stress in the physical supply chain. But here's where it gets more interesting. Industrial demand for silver is not slowing down. It's accelerating. We're living through the largest build-out of solar energy infrastructure in human history. Every solar panel requires silver, real, physical silver. Not a futures contract, not a derivative. Actual silver paste soldered onto actual photovoltaic cells. The International Energy Agency has projected that solar capacity additions will continue at record pace through this decade. The Silver Institute's own data shows that industrial demand for silver has been at or near record highs. And while demand surges, primary silver mine supply has been essentially flat for years. You cannot print silver. You cannot manufacture it in a laboratory. You dig it out of the ground. And the easy deposits? Most of them have already been found. So we have this situation. Industrial demand rising, mine supply stagnant, paper leverage at extreme levels, and physical metal flowing across oceans in ways that signal genuine supply chain stress. Now you start to understand why some people are watching this Sunday Open very carefully. The paper market mechanism, what could actually shock. Here's where we need to get a little deeper into the mechanics. Stay with me, because this is the part that most people miss, and it's the most important. The Comex silver market operates on a system of promises. You buy a futures contract. That contract says you have the right to take delivery of physical silver at a specified price on a specified date. In theory, if enough people stood up and said, "I want my silver, give me the actual metal," the system would face an immediate problem. Because the physical metal to back all those paper claims simply does not exist at current prices. Now, for most of Comex's history, this hasn't been a crisis. Why? Because most futures traders never intend to take delivery. They're speculators, hedge funds, algorithmic traders. They roll their contracts forward, or they cash settle, or they exit. The paper game continues, but the threat, the real structural threat, comes when conditions change. When the players who do want physical metal start pushing harder than the system expects. This has happened before. In 1980, the Hunt brothers famously cornered the silver market, driving prices from under $10 to nearly $50 an ounce before regulators stepped in and changed the rules mid-game. Comex literally altered margin requirements specifically to break their position. The price crashed. In 2021, when the Wall Street bets crowd tried to squeeze silver, something interesting happened. Physical silver premiums exploded. Dealers ran out of stock. Mint after mint reported record sales and multi-week delays. And yet, the Comex paper price barely moved and then dropped. Two markets, one physical, one paper. And for a brief moment, they told two very different stories. The question serious analysts are asking today is, how long can those two stories diverge before they have to reconcile? And the mechanism for that reconciliation, the force that could cause a violent repricing, is a delivery squeeze, or a default scare, or simply a moment of panic where everyone looks at the leverage ratio and decides simultaneously that they don't trust the paper. That kind of moment doesn't announce itself. It tends to happen on a quiet Sunday night. The macro backdrop. Why now feels different. But let's zoom out, because silver doesn't exist in a vacuum. It exists inside a global monetary system, and that system is under more stress than it's been in decades. The United States is running a federal deficit that has crossed $35 trillion. The interest payments on that debt, just the interest, have now surpassed defense spending. The Treasury is issuing debt at a pace that is genuinely historic. Meanwhile, the Federal Reserve is caught in an impossible position. If they cut interest rates to relieve pressure on the economy, they risk reigniting inflation. If they keep rates high to fight inflation, they risk breaking something in the financial system. A bank, a fund, a corner of the repo market, the way we almost saw in March 2023 with the regional banking crisis. Either path leads somewhere uncomfortable. And here's what history tells us about these moments. When governments face debt crises, real structural debt crises, not cyclical downturns, the instinct is always the same. They inflate, they print, they debase the currency. It's happened in Rome, it happened in Weimar Germany, it happened in Argentina. It's happened over and over throughout history, because the political pain of honest adjustment is always greater than the political convenience of monetary expansion. And when currencies get debased, hard assets get repriced. Gold goes up, silver goes up, but usually faster and further on a percentage basis, because it starts from a lower base and carries both monetary and industrial demand simultaneously. Now, I'm not telling you a collapse is imminent. I'm telling you the structural conditions that have historically preceded major silver repricing events are more aligned today than they have been in a very long time. The Fed's balance sheet, the debt trajectory, the de-dollarization conversations happening between BRICS nations, the central bank gold buying, which hit record levels in recent years, as foreign central banks quietly reduced their dollar exposure. These are not conspiracy theories. These are documented, publicly available data points, and they all point in the same direction. The smart money positioning. Here's what's interesting when you look at the Commitment of Traders report. The KOT data that CFTC publishes every week, showing how different categories of traders are positioned. The commercials, which includes banks, mining companies, and large institutional hedgers, have historically been net short silver. They sell futures contracts to hedge their physical exposure. But the managed money category, hedge funds, algorithmic traders, sophisticated speculative capital, has been showing positioning shifts that analysts are watching closely. When managed money moves aggressively into long positions in silver futures, it tends to precede sharp price moves. And on the other side, when the commercial shorts reach extreme levels relative to open interest, meaning the banks and institutions are holding massive bets against silver, history shows that an eventual covering rally can be violent, because shorts have to be bought back. Every short position eventually becomes a buy order. The larger the short position, the more violent the eventual squeeze. We've seen this dynamic play out before in 2010, 2011, and again in 2020, where silver moved 30, 40, even 50% in compressed timeframes. I'm not promising that happens now. The timing is always uncertain. But the structural setup, the combination of leverage, physical demand, macro backdrop, and positioning, is as compelling as it's been in years. And if something triggers it, a Fed statement, a geopolitical shock, a bank failure, a default scare anywhere in the system, the Sunday Open on Comex could be the first place that shows up. What silver holders need to understand. Now let's talk specifically to the people holding silver right now. Whether you hold physical coins and bars, whether you hold a silver ETF, whether you hold mining stocks, each of these carries a different risk profile and a different relationship to what happens at Comex. Physical holders are, in many ways, the most insulated from the paper market's short-term volatility. Your metal exists. It cannot be margin called. It cannot be hypothecated. It sits where you put it. But physical holders need to understand something. In a sharp downward move on Comex, even a temporary, technically driven move, the value of your holdings will show a paper loss. That psychological pressure is real. People panic and sell physical metal at exactly the wrong times. The shock, if it comes, will initially feel like it's going against you, even if structurally it ultimately resolves in your favor. ETF holders, and this is the group I'd urge the most caution about, are exposed in ways many don't fully appreciate. The largest silver ETF, SLV, holds silver on behalf of its investors, but the authorized participants, the mechanics of creation and redemption, the custody arrangements, these introduce counterparty risk that physical holders don't face. In a genuine stress scenario, the behavior of ETFs can diverge from physical. We've seen this in other markets. Mining stockholders are leveraged to the silver price in both directions. When silver rises, well-run miners often rise faster. When silver falls, miners can fall harder. They carry operational risk, geopolitical risk, management risk, on top of the silver price exposure. None of this is investment advice, but understanding these distinctions before a volatile open, rather than during one, is the difference between responding rationally and reacting emotionally. The historical rhyme. Let me leave you with a thought that I find genuinely compelling. In 1979, silver was trading around $6 an ounce. Inflation was running hot. The Federal Reserve was being questioned. Dollar credibility was under pressure. Geopolitical tensions were rising. Within 12 months, silver hit nearly $50, a more than 700% move. In 2008, silver dropped to around $9 during the financial crisis, a moment of peak fear and dollar hoarding. Within 3 years, it had risen to nearly $50 again. In 2020, silver dropped below $12 as COVID panic triggered a rush to cash. Within 5 months, it had more than doubled. Within a year, it approached that same $50 level that seems to carry some magnetic quality. Now, silver is not at $6 today. The setups are not identical. History rhymes. It does not repeat precisely. But the pattern of silver being suppressed during periods of institutional stress, then repricing violently when the pressure exceeds the system's ability to contain it, that pattern has appeared consistently enough that serious analysts keep it in their models. The question is not really whether silver will reprice. The question is when, and whether you'll be positioned before it happens, or watching from the sidelines afterward, wondering why you didn't pay attention when the signs were this clear. So here we are, Sunday. The Comex is about to open. The macro backdrop is the most loaded it's been in years. Physical demand is outpacing supply. Paper leverage sits at historic extremes. The monetary system is under structural stress that doesn't get solved in a quarter or a year. And most people, most investors, are going to scroll past this moment without a second thought. That's always how it works. The information was available, the data was public, the signals were there for anyone willing to look past the noise. The question I want to leave you with tonight is this. Are you looking? Because in financial markets, the biggest moves don't start when everyone agrees something is happening. They start when almost nobody believes it yet. We may be at that moment, or we may have more time. The timing is never certain, but the direction of the pressure, that's becoming harder to argue with every week. Watch the open, watch the volume, watch what happens when Eastern markets come online and the paper price meets a world that's been moving physical metal at a pace that tells a very different story. And if this was useful, If it made you think differently about what's building beneath the surface of these markets, then share it with someone who needs to hear it. Because the best time to understand a market is before it moves, not after.